Today's question comes from Michelle S. Here's what she wrote. I'm a future client and I have a few questions. I recently came into enough money to pay off all of my debt except my vehicle. Is it better to pay it all off in one payment, or should I make multiple payments over a few months? Which is better for my credit rating? Thank you, and I'm looking forward to buying my first home with you. So if you have a question of your own, just like Michelle had, post it in the comments. And if you'd like the info I'm sharing with you, I'd appreciate a thumbs up. My name is Scott Wynn. I'm with the Wynn and Eagan team at Citywide Home Loans. I work with my wife, Marla Wynn, and our business partner, Joe Eagan. Now, in my opinion, Michelle's question is actually two different questions. So the first question I see is, should you pay off all of your debt at once or make multiple payments? But the subsequent question that she didn't necessarily ask directly is, should you pay off debt or should you save for down payment? And I'm going to address both of these questions here today. So let's talk about credit first. See, a lot of people think credit is being continually updated and continually monitored, and that's not the case at all. In fact, credit is more like a snapshot in time, something that when you pull credit will allow you to see your credit score at that specific moment based on what has been updated on the credit. So in terms of Michelle's question as to whether she should make payments towards paying down that debt or pay it off all right now, my suggestion would be that she pay it all off right now. That's going to have an immediate impact on credit in terms of the credit utilization ratio, the amount of money that she owes versus the credit limit on her credit cards. And as long as she doesn't close that account, will continue to provide benefit of having an open account with a good payment history. So in terms of credit, that's the quick and easy answer. Pay off the debt rather than keeping it in place and paying it down gradually over time. But should she and should you pay off your credit rather than doing something else with the money that could be maybe more beneficial when it comes to mortgage qualifying? See, if you're using your money towards improving your credit or paying off debt, you're taking money away from an alternative, such as paying more money towards a down payment or closing costs that could put you into a better loan situation. And if you're interested in understanding how much money you need for a down payment, I've recorded a video that discusses exactly that. What is the minimum down payment required for mortgage qualifying? I also recorded a video talking exactly about how much money you need for closing costs. Two of these videos are going to be very helpful to you as you start planning your home purchase plan and how much money you need available for closing costs and down payment. Now, when it comes to getting the best mortgage terms possible, really it's all about balance. And my guess is that the reason that Michelle's asking this question, and you might be watching this video, is because you want a better credit score so that you can get better mortgage terms or a better interest rate. But if you're using your money to improve your score, you may have to use a program that requires, let's say, down payment assistance that carries a higher interest rate, or a loan program that carries higher mortgage insurance that might end up costing you more than what you would otherwise be able to get if you were to put maybe more money down rather than working on the credit score. So if you're interested in learning more about mortgage insurance and what it is and how it works, here's a video that I've recorded as well that you might want to check out. Sometimes when you are looking at improving your credit, maybe not just associated with paying down credit cards, but let's say working to improve your score in general, one of the things that many people like to do is pay off old negative items such as collection accounts. But in that case, you may actually be doing more harm than good in working on improving your credit. And here's why. Credit and collections kind of have a weird dynamic. Collection accounts in many cases get reported one time, months or even sometimes years ago, and then those collection agencies stop updating your credit, kind of that snapshot in time again from a credit perspective. Well, since maybe it's been months or even years since that collection's been updated, even if there's a balance, it's having a lesser and lesser impact on your score. If you were to go out and pay that collection account off, what will happen is that the account balance will be updated to zero, and so will the most recent activity. And so therefore, you're going to have a negative account, the collection, with a recent activity date, which is going to temporarily drop your score. Now, over time, yes, the credit will go up. However, from a mortgage qualifying perspective, that can be a bad thing, especially considering that many times collection accounts don't have to be paid off in order to qualify. Now, that's a very individual situation and something I would recommend you speak directly to a mortgage advisor about before making any final decisions, but just something to be aware of, that you might be thinking you're doing good things when in fact you're not improving your situation at all. Other times, paying down credit card balances may have such a minimal impact on your score that you would have been better off using that money for down payment. See, when we work with our clients, we like to do a full assessment of their situation. We like to look at what their credit score is, what's going on their credit, how much do they have available for down payment and closing costs, and what does their time frame for home purchase look like? Because all of those things will play into the strategy and the plan that we will take in order to make this all possible and get them the best possible terms they can. The other thing is that many people go through and are planning on making a home purchase and improving their situation so long that they actually end up negatively hurting themselves that way as well. Consider that home prices are going up by about 4% every single year, and we're at historically low interest rates, which makes housing very affordable right now. It may be better to get going sooner rather than later before you work on improving your credit score and saving even more money for down payment that you now can no longer even afford the house that you wanted to because it's out of your price range. So how do you know? How do you find out what you need to do in order to make a home purchase possible under the best possible terms? Well, the first thing you're going to want to do is understand what credit score you need and the down payment that you have available for yourself when it comes to buying a home. For example, if you only need a 660 credit score, then stop shooting for a 720 or 740 credit score, as it may have very negligible impact on your mortgage qualifying and the loan program that you'll get. You may just end up wasting more time and money than you need. Then use the funds that you have available for down payment, closing costs, buying down your interest rate, or setting money aside for anything that comes up after closing if you don't need it to improve your credit situation to qualify. So if you have a specific question, because it's very hard to anticipate everybody's individualized questions, leave it in the comments below and I'll do my best to give you a quick answer or provide you a more in-depth video if it's relevant. Or if you have another question related to buying a home or doing a refinance, leave it in the comments and I'll record a video just like this.